Okay, I think we will start off with the webinar, and for those who want to join us as we go on, I'm sure they will do. So today's webinar is about moving or relocating to Gibraltar from the UK and the key financial considerations surrounding this. So we'll try to keep the webinar relatively brief today. There's quite a lot of areas to cover. So we'll try to give as much detail as possible. But if you would like to chat to us personally, you're seriously interested in relocating to Gibraltar and you believe our services may assist you, feel free to get in touch. It's inquiries with an E at fwm.gi, or visit our website, Fiduciary Wealth. And we've run a lot of content like this, some past webinars on Gibraltar, including property in Gibraltar. So please visit our YouTube channel, Fiduciary Wealth, and subscribe, like, share with people who may be interested in, and you will have access to our free content, future webinars and podcasts that we will do. So I'll run briefly what we are planning to cover today on this webinar about moving to Gibraltar from the UK. So we're starting part one, talking about your UK exit and the importance of UK domicile and UK inheritance tax. We'll touch on briefly the kind of post-Brexit changes that have happened for Brits wanting to move to Gibraltar. We'll talk about the residency options, the tax benefits of living in Gibraltar, and the tax tax mitigation and succession planning opportunities available. We'll then talk about timing the sale of your UK main residence, the implications of the tax agreement that Gibraltar made with Spain, and a bit of an update on the treaty negotiations, the post-Brexit treaty negotiations between the EU, GIB, the UK and Spain. And then we'll cover with a few final questions, bit of advice, and at the end we will answer all your questions that you may have for us. So there's a Q&A function on the Zoom. Please feel free to use that throughout the webinar, and we will answer any questions that you may have at the end. Okay, so we'll start the webinar now. A very brief introduction for those who haven't spoken to us before. I'm Matt Penfold, and this is Paul Correa from Fiduciary Wealth, based in Gibraltar. Okay, so Paul, if you can kick us off, and yeah. I think you're going to tell us a little bit about the best way to plan your UK exit. So yeah, I'll leave it with you.
Yeah, I mean, you need to be aware of the factors which determine whether you're considered UK tax resident in a particular tax year. Clearly, the number of days that you physically spend in the UK is an important consideration, but it's not the only one. There's other things to consider, including the pattern of your presence, as well as your links with the UK, including family, property, possessions, working life, social connections. So essentially what the UK Statutory Residency Test 2013 does, it allows you to plan the date in which you become non-UK tax resident. And in fact, determines also how many days you can spend in the UK and trip back into the UK based on the number of ties you have and connections without re-triggering UK tax residency. So it's a very important thing to consider. We always advocate that an individual, where possible, exits at the end of the UK tax year, so very cleanly on the 5th of April. That is always preferable. But in any event, if you move to a third country, it won't be, the tax year will not be run on the same basis as in the UK. For example, in Gibraltar, it runs from 1st of July to the 30th of June. So it's not going to be perfect. But when you exit the UK, if you don't do so at the end of a tax year, HMRC specifies that there's 3 situations where split tax year rules can apply automatically without being questioned or challenged. If you start full-time employment overseas, if your spouse or lifetime partner is starting full-time employment overseas, or if you cease to have a UK home. I always said that there's no point in moving to Gibraltar to take advantage of a benign tax environment without having first planned your UK exit strategy. It makes perfect sense to seek appropriate advice from a relocation expert who understand the nuances and the interaction between the UK and the Gibraltar tax regimes and can help optimize your tax position. The other thing I would add, which is relevant to the exit, is that very often people leave the UK and forget to advise HMRC of their departure. So they really ought to complete Form P85, and they can obtain that from their local tax office. Alternatively, if they go to www.hmrc.gov.uk, then if they navigate through the website, they should be able to obtain a P85 and complete it. Otherwise you haven't exited for tax purposes, and very often people do it a couple of years later when they're reminded. Well, that doesn't make any sense. You have to do things properly.
Okay, wonderful. And another thing that I think trips people up, but they don't even consider, Paul, is your UK domicile and how that affects UK inheritance tax.
Well, I mean, the good news, no inheritance tax in Gibraltar, as you know, Max. The bad news is you're likely to be remain exposed to UK inheritance tax by virtue of the number of days. By virtue of the fact that UK inheritance tax is not based on the concept of residency, but on your domicile of origin. And the domicile of origin is something you acquire at birth. If you're born in the UK and your father is born in the UK, and if you don't know the identity of your father, then you take it from your mother. Whilst you can claim and acquire a domicile of choice by settling in a country with the intention to live and stay there permanently, the process is fraught with difficulty. There are no fixed rules. The burden of proof always falls on the individual to prove they have successfully acquired a new domicile of choice. And in any event, it's not, and even in the unlikely event that you have acquired that domicile of choice, it's not uncommon for Brits to return to the UK for two reasons: either ill health or the death of their spouse. And even if you were to return for 1 year on a temporary basis due to ill health, that's enough to retrigger UK domicile. Now, theoretically speaking, you can avoid UK IHT after 5 years of non-UK residency. In practice, I think it's more complicated. We go back to the same issues we raised for UK statutory residency test, social and family interest, property ownership, and then intentions. What do you really want to do? Are you planning to ever come back to UK? That is enough to bring you into the UK inheritance tax net. And we know for a fact that even insignificant ties are challenged. HMRC have been known to dismiss claims on the most tenuous of grounds. And the most high-profile case is Richard Burton, the Welsh actor, left the UK in the 50s, got professional advice of the highest quality, moved to Switzerland in 1957, died in Switzerland 27 years later in 1984. The tax authorities then made a claim on the estate on the grounds that he never relinquished his UK domicile, notwithstanding the fact that it severed his links 30 years earlier. They successfully claimed on the basis he purchased a burial plot in Wales. He retained his emotional ties, and therefore we go back to intentions, never intended to return to the UK, even if it's in a box. I mean, it's morbid, but it's a fact. And the fact that he was buried in a red suit and the Welsh dragon colours, holding a book of Dylan Thomas poems, did not help his cause. But look, an estate of £5 million in 1984, which is a fairly large amount, was subject to a UK IHT bill of 2.4 million. So I think that underlines the importance of taking IHT tax planning seriously. It's a voluntary tax, Matt. That's the most important thing, is voluntary. First thing to consider. And secondly, if you look at the Office of Budget Responsibility, they are saying that the average case pre-COVID, the average inheritance tax bill per estate pre-COVID was 206,000, and this year it's expected to go up to 266,000. And the reality is, once you're non-UK tax resident, it provides you with a fantastic tax planning opportunity to either eradicate completely or mitigate significantly your UK IHT liability. Why wouldn't you do it? It makes absolutely no sense.
Perfect. Thank you, Paul. And yeah, it's people come here, they think, oh, no inheritance tax in Gibraltar. They get a little excited about that and ignore the fact that there remains exposure in the UK. Perfect. So we'll move on to the next part, Paul, and back to you again. So post-Brexit, so there's been some changes for Brits wanting to move to Gibraltar. Can you explain what's happened and what the impact of that is?
Well, I think British nationals are a bit, they think they can just land here, and the fact that they're British passport holder confers rights to stay and to live. And I don't think it's as straightforward as that. And remember that some of the schemes, the less onerous tax schemes like self-sufficiency, were born out of when Gibraltar, as part of the UK, were members of the European Union, and the self-sufficiency scheme required EU approval. So it's essentially an EU approved scheme because it conferred, the ability to mitigate tax on passive income. And, within the European Union, there's rules on a fair playing field in terms of tax, yeah? So you can't just establish a scheme and expect it to be acceptable to the European Union. So it did require sign-off. And what's happened is all residency applications are processed under the provisions of the Gibraltar's Immigration, Asylum and Refugee Act. And because that was done at the time where we're part of the EU, they continue to treat British nationals as who have no material connection with Gibraltar as if they were still EU nationals. That act has not been amended to reflect the post-Brexit scenario. So the implications are that any British nationals wishing to take up residence in Gibraltar must now do so as a qualified person. And the practical effect of this definition is that you can only take up residency on self-sufficiency if you are a UK pensioner who intends to make Gibraltar the permanent home, and they are prepared to transfer their UK medical rights, to Gibraltar, right? So you transfer your medical rights from the NHS to the Gibraltar Health Authority, GHA. So if you are of retirement age, that is one route to market. Not easy, not straightforward, but potentially a route. Or if you enter the country on either an employed or a self-employed basis. So there's still routes to the self-sufficiency scheme, but it's become more onerous and they can quickly be rejected. So now more than ever, individuals planning to move to Gibraltar, they require a professional by their side that can guide them through this application process, because it's not guaranteed and it's not straightforward anymore, and it takes much longer to get your residency. And of course, there's still the other route, which is establishing residency on a category 2 individual basis for ultra high net worth individuals receiving earned income, active income from various sources, very wealthy, and it makes and if they can be taxed in Gibraltar, then the tax charge, which is around just under 40, shy of £45,000, still makes sense. But for the vast majority, self-sufficiency is the most attractive route, and and you can't just show up because you're a Brit and just rent or buy a property and that's it, and you become tax resident because you don't. And that's really important for people to understand that.
Perfect. Yeah. Thank you, Paul. Yeah, no, I think it's been a huge change, and people don't quite understand it. As you say, they think, okay, I'm a UK passport holder, I have a right to move to Gibraltar. That's not the case. And yeah, you have to be of state pension age to be able to transfer those rights. Those people who are able to find employment here are work self-employed.
And if I can just add something, I mean, one has to look at it also from the perspective of the government of Gibraltar, which is a very small jurisdiction.
Yeah.
And self-sufficiency really opened the doors for applicants to come here, receiving passive income, not paying any tax of any kind. So they were non-taxpayers, living a great life, but not contributing for the infrastructure and the amenities that they were accessing. So, if it's a problem for the UK with immigration from France, from Africa and so on, you can imagine for a small jurisdiction. So I know it's sounds odd that Brits haven't got the right to remain, but unfortunately, it's become more restrictive. Doesn't mean you can't do it. It means you need someone by your side and to explore whether you can qualify and how to do it best, and who can then submit the applications and with the contacts to get your residency card. Simple as that. It's become a scarce commodity, and it's become a scarce commodity, if I may add. Well, I'll talk about property later, if I may.
Perfect. Yeah. No, it's it's a demand and supply balance, but we'll get to that. So lovely. So we've covered the residency options very well there. Thank you, Paul. So we'll cover the tax benefits, which is one of the great attractions to Gibraltar, and from my experience, people are attracted for two reasons. There's the tax benefits and there's the lifestyle benefits, and sometimes it's 50-50, sometimes it's much more one than the other. Today we won't mention the lifestyle benefits too much, but I think summer is pretty much here, Paul. So for those who are experience the rain and the cold in the UK, there's one example of that. So on the taxation benefit, so income tax is slightly different to what we're used to in the UK, and is the case in many countries, in the sense that normally tax works on a progressive basis. The more you earn, then you pay a higher tax rate. In the UK, there's the free tax bands. In some European countries like Spain, that there are more tax bands, but it works the same way. The more you earn, you pay a higher tax rate on the upper end of your income. Gibraltar is a bit more unique in that sense historically, in the sense that it's worked on what they call a bell curve. So as your income builds up, the tax rate increases until it reaches a peak, and then it reduces down again. So it basically reaches an effective tax rate on income that can be the maximum rate, which was 25%. At the moment, it's 27%. This has increased post-COVID. Gibraltar, like anywhere else, obviously lost out on money. It's a big kind of tourist destination. So the government need to increase that kind of tax income. So they declared that increase for 2 years, which I think we're some way into that, and that may reduce back down. We'll see what the politicians decide on that one. But again, it's a much lower rate than you would expect you're used to in the UK, especially for those higher or additional tax rate payers. In Gibraltar, there's two tax systems. You have the gross income based system and the allowance based system. It's important to assess which is the most suitable for you, depending on your level of income, your individual kind of circumstances. Aside from the low rate of income tax, if you're a tax resident in Gibraltar, you benefit from no VAT, no wealth tax, no capital gains tax, no savings tax, a gift tax. Corporation tax is low in Gibraltar. It was 10%, increased up to 12.5%. And I understand that they're working up to 15% as a maximum. It is possible also, subject to certain caveats, and it can be complicated, to receive dividends from your UK company without tax deduction in both the UK and Gibraltar. That's based on the tax agreement between the two jurisdictions, but there's a huge benefit there that again needs to be looked at because they're kind of caveats based on those. And I think I mentioned capital gains. There's no capital gains. So for those disposing of UK assets, if you're a tax resident in Gibraltar, you can dispose of those without subject to Gibraltar or UK capital gains tax, as long as you remain non-UK resident for a minimum of 6 years. So that avoids someone exiting the UK, selling all their assets, returning. You need to be out for a minimum of 6 years. The exemption to this is, if you hold property and land in the UK, then you continue to pay the capital gains tax in the UK. And the final thing is pension. So you're able to either transfer or establish a Gibraltar pension. If you do this, the tax rate is just 2.5% on income. You still have a 25% pension commencement lump sum, which is the tax-free element of it, which if you've been out the UK long enough, that this can increase to 30%. And on the remainder, you just pay 2.5% on that income. I guess one thing that I added, we talk about if you're a Gibraltar tax resident, and this is maybe answer to some of those people who think, well, our established residence in Gibraltar, but I may not live there. I may live in the UK, Spain, elsewhere. Generally, the assessment is that you need to spend 183 days in Gibraltar, 300 days in 3 consecutive tax years. So effectively 100 days per year. Of course, with that, you have to bear in mind where you are spending the rest of your time. Like Paul said earlier, if you exit the UK but then return and spend too much time, you may re-trigger tax residency in the UK. So we've covered the tax benefits, and there's a huge amount there. And then we just kind of cover briefly your tax mitigation and succession planning opportunities. So I've covered the Gibraltar pension. So if you have UK pensions, you can transfer them to Gibraltar. And once they arrive and you're a resident here, you pay 2.5% on the income. One of the benefits previously, or one of the additional benefits to that is if you had pension amounts that were approaching the lifetime allowance limit in the UK, which was just over £1 million, but the Conservative government have abolished that in their recent budget. Prior to this, if you were approaching that, if you transfer your pension outside of the UK before you breach that limit, then it can continue to grow in Gibraltar, and there will be no further tests on that, which means if it went over the limit, there would be no kind of taxation on that. Whereas if you went over the limit in the UK, you would pay a tax rate of 25% or 55% on the excess. Now that limit has been abolished, so you may be asking me why I'm mentioning that, and the reason we do is, and we can't predict these things, but there's been a lot of suggestions that if the Labour government comes in the next election, which is quite likely if you believe the polls, then the suggestion is that the Labour government will re-establish the lifetime allowance limit on UK pensions. Whether they do or not, we don't know. What limit will be introduced, we don't know. But there is a window of opportunity for those as a Gibraltar tax resident to transfer their pension across, and they don't need to be worried about kind of future legislation changes in the UK on UK pensions. Now, as an aside to that, if you're a Gibraltar tax resident, you could also establish a QNUPS, which is a qualifying non-UK pension scheme. So that's a sister product of the QROPS, which is what I've been talking about, which is when you transfer your UK pensions to Gibraltar. Now, a QNUPS is funded via lump sum investment, and care needs to be taken with a QNUPS that it has to be established as a genuine pension scheme. And what we mean by that is the funding has to be in line with your wealth, your age, and your income requirements in retirement. I guess an example, what we mean is if someone's got a wealth of 4 million, they're approaching their 75th birthday and they say, oh, this sounds great, I'll invest 3.5 million in this. It wouldn't be a genuine QNUP. So that has to be assessed by a professional. But the reason somebody may want to consider using the QNUPs is A, on the income payments is only going to be 2.5%. Less if you factor in the 25% tax-free allowance. But a very strong reason is a QNUPS is a pension, and pensions are outside of your estate for UK inheritance tax. So if a QNUPS is set up as a genuine retirement vehicle, the funding is done properly, then it will be outside of your estate for UK inheritance tax, whether you return to the UK or not. So Paul talked about earlier about your UK domicile and you're likely to retain this. A QNUPS helps you plan against that. Even if you return to the UK, when there will be no doubt you are UK domicile for UK inheritance tax. So it's a very powerful tax planning tool, which there are more in Gibraltar, but we wanted to highlight that one for everyone today. So we'll move on and again, slightly tax related, but back to the UK. So Paul, somebody's moving to Gibraltar. They're planning to sell their UK main resident, like a lot of people do, and maybe invest that money in Gibraltar. Do they need to consider the timing of that?
Just a second. Well, okay, can I just go back a step? Sorry, where are we on the? I think we need to go back a step. Look on the Gibraltar property market. I think one point to consider: prices have almost doubled since the pre-pandemic levels. So it's a very hot property market. There's a supply-demand imbalance because of the very few new housing projects coming on stream. I mean, there's 2 or 3 very large ones, significant ones, but there's still 2 or 3 years ahead, if not more. So that means that demand outstrips supply. And then there's been a huge influx of new arrivals from third countries wanting to establish their residency here, whether for employment, self-employment, or on a retiree basis. So that's driving the property market. I mean, the practical effect of that, Matt, is that very often they struggle to find property to rent. The price to rent has become extortionate. And if you buy and if you hesitate, someone will come in and just take the property off your hands. So anyone thinking of moving has to factor that in. Price of property, rental prices, and whether they can afford it, because it's really gone through the roof. I'm not saying it's not accessible to the average individual, but you need to consider the cost of property.
No, of course, and yeah, we said it, and again, Gibraltar is a small jurisdiction. There's a lot of demand, and supply can't keep up with that, and naturally prices will increase with that. So perfect, thank you, Paul. And then, so if we lead on from that, someone's looking at the Gibraltar property market, they're selling their UK home to buy here. What do they need to consider with the timing of their UK main residence?
Yeah, good question. I mean, if an individual is planning to exit the UK and move to Gibraltar, then one of the things they need to consider is whether they're selling the UK main residence or not, and whether the proceeds of a sale would fund the acquisition of a property in Gibraltar. It would be advantageous to do so whilst capital gains tax exemptions for principal private residence relief remain in place. If you sell your property before leaving the UK, then of course, clearly, yeah, the sale of your property is exempt of capital gains tax. If, however, you were to sell your main residence after you left the UK, then it's important you do so within the first 9 months after having left the country. Because these non-resident capital gains exemptions generally stick for about 9 months. And after 9 months, the exemption gets diluted over time. So that's probably something that one needs to consider, because if you don't follow a certain sequence and order in terms of exiting one country for another, and you don't give consideration to when you want to sell your main residence, and if you've built a lot of capital gains into that property, it's a property you've held for 20 years and you're sitting on a huge gain, and the intention in any event is to sell at some point, you might as well sell it then within that 9-month period or earlier. Realize the cash, maybe you want to buy a small bolt hold in the UK should you wish to return occasionally for family or whatever, but avoid the capital gains tax liability that you may have on the sale. So these are little nuances that you have to factor in your move, I would say.
And it's all part of the planning process. I think, yeah. Unfortunately, you know, a lot of people have this dream move to Gibraltar, and if only it was as easy as, you know, you pack up the car, you drive down and you fly over. But there's a lot of planning and a lot of opportunities, but people need to plan properly. Okay, so we've just got a couple more parts to end on. Paul, there was a tax agreement signed between Gibraltar and Spain, which was, I guess, unusual, some may say. What are the implications of that?
Yeah, if I remember correctly, the double taxation treaty with Spain was signed in, you know, probably in 2019, but effective, I think, March 2021.
Yeah.
And one of the things, which is because the agreement doesn't follow OECD standards, which are pretty much a template double taxation treaty. There's political elements to the agreement, naturally, because of the long-standing relationship between Gibraltar and the UK. Gibraltar and Spain. Then there's they've introduced political aspects to what is essentially a tax agreement. And, within the double taxation agreement, it clearly states that if you obtain one of the residency schemes in Gibraltar, that doesn't confer any rights or doesn't provide any immunity from challenge by the Spanish tax authorities if you trigger tax resident in Spain, and you can do so if you spend 183 days or more, or if your center of economic and vital interest are in Spain. In other words, you've got a Gibraltar tax residency certificate, but your wife, your center of vital interest, lives in Spain, and your children are attending a private school in Spain. Well, your center, and you have business interests which operate from Spain. Well, your center of economic and vital interests are in Spain. You might spend 179 days just below the threshold, but your center of economic and vital interest supersedes the 180-day rule. So even the double taxation agreement clearly states that having a tax residence in Gibraltar doesn't protect you under the double taxation agreement from being considered tax resident and being challenged. So I think that's one of the things to to factor in. The other thing is post-March 2021, you can correct me if I'm wrong, Matt, but I think if you're a British national, if you're a Spanish national, you can forget it, because regardless, you'll always be tax resident in Spain. But because our market and we serve predominantly British nationals, will limit the response to a British national planning to leave the UK for Gibraltar. The one thing you need to consider is if you leave the UK and become tax resident in Spain and stay for more than a year and then want to move to Gibraltar, so you need to plan and think this carefully. Then under the terms of the double taxation treaty, you're still, so you move in 2019 to Spain. And in 2023, you wake up one morning and you say, I've had enough of the taxes, I'm moving to Gibraltar. And that's it. I'm not paying Spanish tax anymore. Well, under that double taxation agreement, you're still deemed tax resident in the current tax year and in 4 further tax years. So in 2023, then, it'll be until 2028 or whatever, 2027, when you are effectively, you've escaped the Spanish tax then. So in terms of planning, you have to think carefully whether you want to become tax resident in Spain because you're closing the door to Gibraltar tax residency, or you're leaving it open, but you'll still be paying taxes in Spain as if you're a tax resident for 4 or 5 years. So it makes it less appealing. So I think one has to consider that fact. And if you're already living in Spain, then let's be clear. You can move to Gibraltar whenever you want, but there's still pain in Spain in terms of tax for a further 5 years, even if you get your residence certificate. And there's no escaping it because it's, there's common reporting standards and it's captured by this double taxation treaty.
Perfect. Thank you, Paul. And I like that. Tax pain in Spain. It's a nice little phrase.
Exactly.
And so finally, so post-Brexit, there's been talks between the UK, GIB, EU and Spain. People are very interested in that, and they're still ongoing as far as I'm aware. Is there any update we can provide on that?
No, I think local politicians and the other negotiating parties are remaining tight-lipped when it comes to private negotiations and conversations regarding the treaty. They continue to be ongoing, but there seems to be some kind of block there. And I think Spain is trying to introduce some political elements to what is a treaty governing post-Brexit agreement covering fluidity at the border and so forth. So there's been no progress. All we know more recently, well, let me go back. What we do know is that the British side, both Gibraltar and the UK, is trying to obtain unfettered access to the Schengen area, but not direct membership of Schengen. Now, to achieve that, Spain wants boots on the ground, and Gibraltar and the UK position is that's not going to happen. I think that it would appear is the main problem. So if it gets resolved, you've got fluidity at the border, which is important for the continued prosperity and economic growth of Gibraltar, which is the economic engine of the hinterland, contributing 25% of GDP both directly and indirectly. And then unfettered access to Schengen is great because you become Gibraltar tax resident, and then it is the one thing that at least you can reverse from Brexit, that you're no longer subject to the 90-day out of 180-day rule. You can spend 180 days consecutively, so long as you don't reach the 183-day threshold. So there's clear benefits, but the treaty is not moving. The only news we've had of significance is that, the Deputy Prime Minister in the UK, Dominic Raab, resigned last week. And apparently the reason he resigned, or one of the reasons he cited, was that the British ambassador to Spain Hugh Elliott, who used to be on the negotiating team. He was acting outside his breach and conceded on the point of letting Spanish boots on the ground. As a result of that, it would appear there's contradicting stories in the media. It would appear that then Dominic Raab removed him as one of the negotiating team and put someone else in. They say, I don't know whether it's true, it was the former British ambassador to Spain, Simon Manley, who became part of the negotiating team. And then Hugh Elliott, again, it would appear, he made a complaint of I don't know, I think bullying is
It was, yeah.
is bullying, and but we don't know where the truth lies, because everyone has a different view. But that's where we are. I think it's hit political roadblocks. And in fairness to the EU, it's not driven by the EU, it's driven by Spain. I think there's a bit of frustration in the European Union that Spain is introducing these political elements to the treaty negotiations. So there's a high probability that the treaty never sees the day of the light of day. We have to wait and see.
Yeah, I think that is just a stalemate at the moment, and can you see either side conceding? I'm not sure, but
no,
time will tell. Time will tell.
Yeah, I think the positions are very deeply entrenched. So
Perfect.
Unlikely.
Wonderful. So that is really near the end. Paul, we have a couple of do we frequently ask questions that we receive?
Okay. Let me see. Yeah, I think one of them we've covered already, the property market for rental and sales.
Perfect. Yep, exactly. Thank you.
And a second one, I don't want to ask too many questions because we're limited by time. Can I be registered in Gibraltar and pay less tax, but live in the UK or Spain?
Okay, that's a simple one. And I think you've kind of covered that a little bit anyway, but no is the answer. You can't have your cake and eat it. If you want to be a Gibraltar tax resident, you have to spend sufficient time, and Gibraltar has to be your home. So perfect. So one last point we like to end on, Paul, and can you give us one piece of advice then that you would give to anyone looking to move to Gibraltar from the UK?
Well, it's becoming increasingly difficult to obtain Gibraltar residency on self-sufficiency grounds, which is the most popular route to market. And that is a fact. So there's a scarcity element. One, scarcity is the lack of property. And two, the fact that becoming Gibraltar residents on self-sufficiency ground is become much more onerous, and it's not straightforward. You can't, because you've got because you're a British passport holder, doesn't mean you can just get on a flight and you have the right to remain. And things will get even more difficult moving forward because politicians, and there's an election this year already making noises that are going to tighten the rules. I would say don't think you understand it because it's complex and difficult, and don't think you can do it on your own because you probably can't. You need some connections, and missing a key step in the process can be very painful and very costly. So my advice would be, get in touch with a professional firm who knows what they're doing and let them guide you through the process, because it's going to make it uneventful and painless. And it will assure a smooth and seamless transition to the new country of residence. Trying to go alone is like hitting a wall continuously and not learning the lesson. You're just going to bounce back and you're going to be frustrated. Now more than ever, it's important that individuals seek professional advice and they accept that they can't do it on their own, because the reality is that they can't.
Absolutely. Yeah. And completely correct. Perfect. So we've reached the end. We invite questions throughout, and we do have the one question there. So from Nietzsche, thank you for your question. So it says, Do I understand correctly that you only pay 2.5% income tax on pension income? Does that apply to income from an annuity? Paul, do you want me to take that one?
Yeah, you can take it. Yeah.
Okay, so Nietzsche, I think you're kind of half correct there. So we talk about 2.5% income. That's on local pension. So we're talking about a Gibraltar QROPS or a Gibraltar QNOPS. If you have so this is where you could look into the option, if possible, of transferring your UK pension to a Gibraltar QROPS. If that's not possible, or you already have a annuity plan, then that will be classed as income, and you'll pay at the standard income tax rate. So although maybe not as high as the UK, we're talking 27% on as an average tax rate on that. So from the annuity, no, but it is possible to have pension income at 2.5% if you're using the local schemes. Okay, wonderful. So my pleasure, Nisha. Just thanking for the answer. Very polite. So thank you so much for those who've joined us today. If you're live with us or watching this recording on YouTube, again, we ask and it would be greatly appreciated if you could subscribe to our YouTube, like and share some videos that you're enjoying on there. There'll be plenty more free content coming from us in the form of webinars and our podcast that we're going to be providing that content on. So please do that. For those seriously considering Gibraltar, and if today has shown that this is an option for you, then reach out. We're more than happy to have a chat with you and discuss what we can do for you. So for today, we'll say thank you and wish you all a lovely day.
Thank you.
Thank you. Bye-bye.
Bye-bye.